Well, good morning, everyone. Rachel, can you hear me okay? And anyone not able to hear me? Welcome to our quarterly economic outlook. This is something we have done. We were doing sporadically in 2021 and beginning of 2022, and we've tried to make this the regular, really a regular event, this economic outlook. Now, what I want to say up front is you guys, many of you know me very well. I claim to be certain things, but I don't claim to be an economist. I can tell you that. I'm a strategist, and I work with many of you on your strategy. But what I do believe is that as an executive, every one of us should have a view on where we are from an economic standpoint, and equally important, where we actually are in the cycle and what are the strategies we should be thinking about and implementing on behalf of our business. So this is something that I think has become much more critical to me over the last couple of years because, obviously we've had some really crazy economic times with the pandemic, and then, to move into a war and all the impacts that it's had on the economic outlook. So I think it's really critical if you're a leader in your organization that you're forming some type of view as to where you are in the cycle and what are some of the things we should be doing to prepare our businesses for that. What I'm going to present today is an outlook. It's not going to be a regional outlook on the capital region or on any region per se around the country. This is about the U.S. economy. And what you really need to be thinking about as you look at it is, do you need to make any adjustments for your industry? Or your marketplace. And a great example is Brian Miranda from Miranda Real Estate. Last time we did this in the fourth quarter, one of the things that he talked about was that the real estate market was actually holding up reasonably well in the capital region. So that's a great example of taking, we were talking about how there was a housing slump nationwide. So you need to be able to think about this relative to your particular marketplace that you participate in. I'm going to present some thoughts. You're going to see we're going to work through thoughts, but then I want to get your thoughts because I think the real power of pulling this group together is that we can sort of share what's going on in our businesses and see if there's any additional insight that will help others that are on the call. So, Rachel, are we ready to go? This is going to be our first slide. So where we left off last time we talked, and it was a great discussion. We had rising inflation, rising interest rates, stock market downtrend, declining consumer confidence, and we're in a bear market. So this was back, in the fourth quarter as we were looking at, as we moved into the fourth quarter. These were things that were out there. The truth is that much of this is still the same, except I want to make a couple of quick comments on it. First of all, as it relates to rising inflation, there has been some good news over the last month where it looks like inflation is starting to moderate a little bit, but still it's very high by historical standards. So we've got to keep an eye on that. Rising interest rates also have been moderating a bit. We're going to find out, I guess, tomorrow. Really where the Fed's going to end up. Everyone's anticipating another 25 basis points increase, and perhaps another increase after that. I guess we'll get some better insight tomorrow and beyond. But the markets kind of believe that we're going to have this one, there's going to be this one additional interest rate increase. And then toward the back end of the year, we actually might see interest rate cuts. So depending on that, what we hear from the Fed over the next couple of days, I think that we'll have maybe a little bit more insight on that. Stock market downtrend still is in a downtrend. I'm going to walk through this with the economic scorecard, but January has been a good month for stocks, particularly on the long side. And so as we've talked about in previous sessions, stock market is a leading indicator. And January, it's been good, although these last 2 days, it looks like it's going to open down today. But yesterday it was down a bit, but still a pretty strong month overall. Declining consumer confidence, you'll see in my scorecard that the reality is that it still is very low by historical standards. And this is what drives sort of spending. and ultimately a big input into our economy. It still is low, but it did improve over the last month. Some good things on the horizon. And as far as I see, I think we're still in a bear market, and that ties back to the stock market downtrend. And my view is that I think there's probably another leg down, not too far down the road here. So, but anyway, those are just some thoughts about where we left off. So I think things have improved on several of these areas, but not significantly, and haven't taken us out of the danger range of a recession. Okay, right, Rachel, let's keep on going. So here's a few things that we pulled up that we saw out. Many of you are probably feeling this. Nominal wage growth is still at the highest point in decades, but real wage growth, when you factor in inflation, is negative. And frankly, when you look at any of the consumer confidence numbers, you see that one of the big concerns is that expectations are that wages are not going to keep up with inflation. So that is a concern as people look out on the horizon. The good news on the manufacturing front is the supply-related pressures have started to ease. This is from Fidelity. But you still see that housing and food inflation, although housing is moderating a little bit, and so is food inflation, but still pretty high by historic standards. So those are both from Fidelity. Just taking a look at a couple other things that we're hearing out there from, I'll call it, thought leaders. JP Morgan's talking about the volatility of 2020 and 21 and how quick and how deep that downturn was. Really was followed by a very strong rebound, and personal balance sheets grew pretty considerably. And it's really made our economy a little bit more stable through some of these fairly difficult times. And then lastly, Goldman Sachs talked about, what is really the view going forward. They view it as another year of below, call it potential growth. There's going to be a lot of labor market rebalancing, they believe, in 2023. And it'll solve some of our inflation problem. And there's some other signs on the horizon that I see in terms of things I watch, where I think that the labor market is just cooling down just a little bit. Some of you that are in HR roles or other leadership roles, maybe you're feeling some of the same thing. And we'll talk about that when we get into the open session on the back end of today. So I want to share with you a scorecard. So this is not the scorecard of all scorecards. This is a scorecard I like to use, and I like to use this when I'm working with our clients from a strategy perspective. I view it as really a compass for me in terms of thinking through all the different aspects of the economy. So those of you that are new to this and haven't seen it before, you'll see that it's abbreviated. There's lots of economists that'll kick out all kinds of data. I just wanted to get to some basic things that can help me think about my business and our clients think about their businesses. So let me tell you what it's showing us now. In terms of a few things to be aware of, basically everything you see in bold on the indicator side, yield curve, stock market, earnings calendar, GDP, inflation, all of those things contribute to my economic outlook. And so what I want to do is I want to talk you through sort of where we see it right now. And you can see an awful lot out there in that right-hand column. And there's a lot of debate about whether we're going to have a recession and whether it's going to be a soft landing or whether it's going to be a hard landing. Be glad to talk about that a little bit. Or it's just going to be a rolling recession, which means various industries are going to go through it at different points in time, and maybe some of your industries already have. So we'll be talking about that. But so let me talk about why these things are important. Historically,
right about 40 pages, a couple chapters of that book. But, yeah,
you guys make sure that you mute yourselves because we're hearing some back talk. Okay, so yield curve. Why is this important? Yield curve is a great predictor of a recession. And the problem that we have right now, and we've had for a period of time, is we have something called an inverted yield curve, which is a huge indicator of an impending recession. And what that really means is that short-term rates, as dictated by the Fed, generally speaking, that's why the rise in interest rates, what they do is interest rates are elevated or escalated so that they cool down the economy. And by cooling down the economy, generally you're going to drive a contraction, which is why it's such a good indicator of a potential recession. And unfortunately, we've had an inverted yield curve for a period of time. As of this meeting today, we've got basically 3-month, T-bills at 4.72% versus 10-year interest rates at 3.5%. And so you can see that short-term rates are higher than long-term rates, which is generally indicative of a impending recession. Stock market. Although the stock market, I said, has had some good things going on, there is an upward sloping 50-day moving average. Still, the 200-day average is down sloping. And those of you that invest your own money or invest through others, the S&P 500 right now is basically at what they would consider to be a key resistance level, which is 4,100. And if it breaks through that, then there could be good times on the horizon. But it's been sort of stalled there a bit over the last week or so. So generally speaking, we're still looking at a down-sloping stock market or bear market. Historically, a stock market that's is a leading indicator of the economy. And so I would say that right now, that particular indicator is sort of leading us toward risk of recession. Earnings calendar. You've heard me talk about this before. So I basically track 10 companies that I think are sort of the bellwethers that are out there. That's GE, Microsoft, Intel, Alcoa, Procter & Gamble, FedEx, Pepsi, DuPont, UPS, and Google. So you can see there's some new economy and some old economy companies there. But anyway, so when I look at this, I'm looking at, so how did they report? Did they exceed revenue targets, earnings per share targets, and what's their guidance going forward? And generally what you're trying to do is get a sense for are businesses contracting or not? And unfortunately, what we're seeing is 6 out of 10 of those companies most recently exceeded revenue targets, but there were 4 that didn't. 7 exceeded earnings per share targets. So it sounds pretty good, but they, going back 2 quarters ago, all of them were exceeding both of those. And probably the more important thing is that 6 of the 10 are actually leading toward either weak or no guidance at all. So this is really sort of pushing the thought process that, earnings are telling us that we're probably leaning toward contraction or recession. So that would be solidly in that camp. Some of you maybe have heard recently the GDP numbers that came out, which were actually encouraging. And that's why I sort of have this on the neutral side. But there are some things that are concerning about it. So GDP grew, GDP is a measure of our economic growth as a nation. And we were up 2.9% for the fourth quarter. It was the second quarter in a row where there was actually growth. After the first quarter and second quarter of 2022 were both contractions. So everyone felt like we're moving, fast and furious toward a recession. So there's a couple of things that feed into that, and into the GDP formula. It's consumption, which you can see it's 2 lines down here. Consumption is generally leaning toward weak. One of the struggles that we had on the consumption side is that consumer confidence continues to be real low. Retail sales have weakened quite a bit, although I still have it in neutral because there's a good chance that we'll get a bit of a rebound. I actually had it in expansion the last time we got together. Retail sales were strong. But they are weakening, so I've moved that to neutral. And new home sales still, generally speaking, very weak. And although the new home sales did improve just a little bit over the course of the last month, still pretty weak overall. And it's down 26% versus a year ago. So both of those are sort of leaning us, both consumer confidence. And then you look at new home sales and sort of a deteriorating retail sales environment. I feel as though that consumption is going to weaken, and so therefore the risk of recession increases, and that's why I've marked that under that box. When we look at the second ingredient that we have that goes into GDP is business investment. So what's business activity look like out there? And the truth is that it decreased this past month. The ISM Manufacturing Index, which is a great indicator of business activity and ultimately a key driver or a key indicator of whether it's going to be a business-led recession. It dropped into the below neutral threshold of 48.4. And so for those of you who aren't familiar with it, anything above 50 is considered expansion. Anything below 50 is considered contraction, which is consistent with a recession. And so that 48.4 was problematic. The view is that the business appetite and most of the components of that decreased. New orders decreased, backlog orders decreased. The employment index actually in manufacturing actually even decreased. So in my mind, there's there's some headwinds on the horizon related to that. So manufacturing is slowing. So talk about the third component is net exports. Obviously, if we're exporting a lot as a country, then we're growing from that. And if we're importing more than we're exporting, that's a drag on GDP, on the GDP formula. And what I would say is that although this generally looks neutral, I'll call it, because imports actually decreased. So we were buying more from other countries. So that made the net exports formula look better. But the reality is that exports also declined. And so the concern here relative to net exports is that although I have it in the neutral ground, is that actually spending in general on imports as well as moving exports are both declining, which means that there's more of a global slowdown. And so the concern there is that it not only will impact the US, but that it's something broader than that. Now, having said that, there was great news that came out over the last 24 hours on Europe. There's a view now that Europe may not enter a recession. I'm not convinced yet, but that is out there on the horizon. The fourth component that we have is called government spending. So we all know that our government likes to spend and has spent for a lot of years. But basically, when we're spending a lot, that actually adds to GDP. There's more money that's going into the system. And basically, government spending has been very strong. It was up again in December. Pretty significantly. A lot of the spending we're talking about is Social Security, Medicare, interest payments on our debt, et cetera. But the reality is that it was a contributor to GDP because it was actually the government was putting money into the system. Now it's dangerous because when you're running those deficits, you also have to pay interest on it, and eventually the debt needs to be paid. So long term, not great, but in the short term, it helps to foster more of an expansion of our economy. And so that's the view on the horizon. So that one I would actually say is as being positive in the short term relative to expansion. So the big thing that everyone's been talking about over the last quarter has been inflation, and when is it going to moderate? So the good news is on the inflation front, there's the CPI, which is the consumer price index, and then there's the producer price index. One is tied more to businesses, and one is tied a little bit more to the consumer. So the idea is that the CPI is improving, but it still is very high. We haven't contained it yet, so it's solidly in the camp of it's sort of creating a risk of recession. The producer price index as well really fell. It fell in December again, but still up pretty significantly, still high overall. But there is some good news on the horizon. It is moderating. So if I were going to characterize where I think we are from an inflation standpoint, is that it feels as though we're moderating. Okay, we're not increasing like we were before at the same rate. We're starting to decrease, but still inflation is at a pretty high level. So overall, unfortunately, I'd like to give you better news for running your businesses, but I feel like we're still headed toward a recession. There's a lot of discussion about this. And when people talk about recession, they talk about a soft landing versus a hard landing. Hard landing is, all of a sudden we're going to hit a wall. and business is going to slow and spending is going to drop so significantly, people are going to lose their jobs. That's a hard landing. And what the Fed's been trying to do is increase rates moderately. They did it pretty aggressively in the beginning, but they're trying, the view is that they're going to slow down a little bit here so that they can engineer what is a soft landing, so that, yeah, we may contract, but we're going to contract at a fairly limited feeling. So it's hopeful that we're not going to be feeling it as an economy at the level we would with a hard landing. But let me tell you why. I mean, you can look at my notes here as well if you ever needed to really think through it on your own. The problem is we still have rising interest rates. So that's still driving us toward risk of recession. I mentioned the inverted yield curve. Stock market is still in a downtrend. So until we see it break through resistance, that's not going to be a positive thing. Inflation is moderating, but it's still high. Consumer confidence hasn't come back, particularly expectations as they look out a year or so. Declining new home sales, housing market still struggling, and then deteriorating retail sales. So retail sales, I still have that in the neutral, but unfortunately, we had a little bit of a setback in December. Holiday season was not that strong. Slowing business investment. It's really business activity, as I mentioned in the ISM Manufacturing Index. And then the last one I wanted to talk about, and I skipped over it, and you may be wondering, it's the Conference Board of Leading Indicators. And, this is something that really sort of packages it all together, and I use it as a gauge of how we see GDP going forward. This is a great, if you do nothing else but you watch this should be part of your leading indicator system. So, for all the reasons, many of the reasons that are listed here under my conclusion or summary, rising interest rates, a slumping housing market, consumer confidence poor, but nevertheless improving. Average initial claims are starting to rise a little bit. So that's the control over the labor market. Construction pulling back just a little bit, again, depending on regions of the country. Manufacturing slowing a little bit into industrial production. There were really only a couple of areas where the indice, what we call the Conference Board of Leading Indicators, actually improved at all. So I think this just, in my mind, I always like to go back to that and say, does it check with some of my logic that I was working through? So if you're in a business and you're thinking about this, you should have some type of scorecard that's giving you some insight as to where we are, because the worst thing you can do is make some slip ups. And I'm going to talk about those now in terms of some of the things that we've got to be concerned about. Actually, before I do talk about that, let's talk about this, which is, I'm sorry, Rachel, I jumped ahead one slide, but this is what I use to really help me gauge whether my logic in terms of where we are from a recession standpoint is really showing through relative to the stock market. So what you see here is a combination of two things. You have on the one, you see the stock market, and really that's sort of the red line, if you will. And where it says market top, it's referring to that's the cycle you typically go through. You go through a bull market, you go through a market top, you go down into a bear market, and then you get to a late bear market. Okay, that's the stock market. Now you might say, well, we're not talking about stocks here. Well, what I'm talking about is the stock market is a leading indicator. And the reason why it's a leading indicator is that if you follow the economic one, which is on the blue, is that generally you see that there is a recovery later. The bull market will always start before the recovery for the economy. And the market top will happen before we get to a full recovery. And you can see that before we get to a recession, we're actually going to be at the end of a bear market. And so I use this to sort of check my logic and say, are we in the same realm? So where I think we are right now on this continuum, let's talk about the stock market. I think we're in a mid to late bear market. Last time we got together, I said I thought we were in the mid. What you are starting to see, at least we've seen over the last month, is the financials are performing a little bit better. Utilities have perked up over the last couple of days, and healthcare was strong, although it's weakened over the last 2 weeks. Energy continues to be strong. So you might say, well, aren't we sort of in the middle because energy has been strong? Really what's happened is energy is being artificially inflated by the war in Ukraine and the energy crisis that we have. But staples in healthcare had performed really well up until about a month ago. So I feel like we're somewhere between, on this chart, the bear market, where it says bear market, and where it says late bear market. And so if you now say, okay, well, what does that mean to me from a business standpoint? I get it from an investor standpoint. I would just take it straight up, Rachel, if you can, from the late and right up to the, so really what we're on the verge of is some type of contraction, probably in, just to the north of that full recovery, or, just north of that full recovery, that one's, there you go, Rach, right there. I feel like we're right there. We're on the cusp. And we talked about this last time. And the great thing about having a model like this is that, the economy doesn't move that fast. I mean, last time we talked, we were in a sort of a similar position. But I think it's really important to sort of judge it against where we are from a stock market standpoint, because it's traditionally been a real leading indicator that by the time we get to a late bear market, we're probably going to start to feel the effects of a recession. Okay. I am going to open up for questions in a couple minutes. I wanted to finish right on the half hour. But let me talk about, so like, what does this mean to a business or an organization, whether you're for profit or not for profit? I spoke about this last time, and this is kind of important because last time I said, as we approach an economic downturn, what are some of the things that what I would call prudent moves to make sure that your organization is positioning well. So if we're approaching an economic downturn, be very careful about adding to our workforce. So, presumably over the last quarter, you've been very cautious about really whether you're adding workforce, particularly if you feel like you're going to feel the brunt of an economic downturn. Probably not the greatest time for you to be making large capital expenditures. You probably want to make sure that you're not being too loose with your credit that you extend to your customers. Make sure that you stay real current on your collections. That's really important. And make sure that you're not driving, big inventories. Like in the retail environment, what everyone's concerned about is retail inventories are really rising pretty considerably. So they obviously didn't see a recession on the horizon. So that's where they're going to get punished. And then generally speaking, as you approach an economic downturn, you don't want to be doing acquisitions, because generally people that are out there selling their businesses to you are thinking about, hey, valuations are escalated or elevated. What you want to do is you want to move your way through the recession and ideally be in a position where you can make an acquisition where you're buying low as opposed to buying high. So as you start to position here, just be careful about overextending yourself. And so we said this last time that hopefully you were preparing for this and you were thinking through this. And what I would tell all of you on the line is that if you really do feel like an economic downturn is either happening in your industry, your segment, or you feel like you agree with some of what we've talked about today, and you haven't done some of these things, I'd be careful. You want to make sure that, you have a sustainable model going forward. So anyway, what could you be doing? Assuming you did all those things and you're in a good position, I would argue that over the next quarter, we're probably going to see continued softening. So I think that the GDP for next quarter is going to be weaker. Whether it'll actually contract or not, it'll be weaker than what we just saw. And as things get weaker and we move into a bit of a recession, there's an opportunity. A lot of people are going to be pulling back on advertising. So you should be thinking about, as we get into the throes of either a recession or a contraction, is there an opportunity for us to really drive our branding and increase market share when most people are being really reactive and pulling back? So being proactive could be a big opportunity for you. This is a great opportunity as you get into a recession or a contraction for you to consider product development. So, for example, when we had the big downturn related to the pandemic, our business slowed considerably, and many of you hung with us very well through that time frame. But we used that opportunity to really build out a lot of our managers' marketplace. And so we use that as an opportunity that while everyone else was sort of pulling back, we were using it to invest in our longer term product development opportunities. Areas for increased capacity. So not so much now, but if you've done a really good job raising cash and you have cash available and debt available, big opportunities as you get into a downturn for you to counter cyclically invest in increasing your capacity. So if you need to add to your facility, et cetera, so that you're well positioned when we start to come into a recovery. So think about, what we want to do is we want to invest then so that we can capitalize on the upturn. Pricing, I think, is really, really crucial. As you move into a recession, be very careful about your pricing thought process. As a matter of fact, conventional wisdom is that as you move into a recession, don't expect your customers. So even if you're in a not-for-profit, don't assume that your people are going to be willing to, and that you're going to push them for bigger donations than what you had before. Or if you're in a for-profit business and you're selling products or services, implementing price increases because you always have, be careful, be very careful. Because you don't want to make it convenient for people to say no. You want it to be convenient for people to say yes. And then I think you need to hold your team together. And some of that might be you have to be creative relative to your wages and hours flexibility. Now we're in an employment environment right now where it's hard to keep really good people. So the more flexibility you can offer them and retain them during that process, I think that's important. So just a few things to think about. As we move into recession, I want you to be positioned to counter-cyclically invest and capitalize on that. So those are some things to consider. So let's just talk about this quarter. I'd say it's the same game plan as the previous quarter. Things don't move that fast. There's a couple of things that I want you to be paying attention to. Listen to the sort of the Federal Reserve analysis on whether we're moving toward a softer landing or we're moving toward that hard landing. If you hear softer, okay, I would accelerate those investment thought process, like your branding and those other things, so that you're better positioned, because really what it means is the contraction is going to be less and the recovery is probably going to be more robust. And because of that, you want to be well positioned. So you want to accelerate those strategies that I just talked about. Number two, if you hear hard landing, if you hear like, oh boy, things are getting uglier, faster, then I would sort of decelerate on those strategies. So the things like branding and increasing your capacity, I wait until I see a little bit more of, how things are starting to evolve. And I think that what's going to drive whether you think it's softer or harder is when you listen to the Federal Reserve analysis that comes out. There's been this big discussion about, are they pivoting or are they not pivoting? What they're talking about is that if the Federal Reserve is inclined to raise interest rates more aggressively, it's considered a hawkish tone. If the view is that they're going to start slowing the interest rate increases and or maybe pivot toward actually decreasing rates somewhere in the not too distant future, that's considered a dovish stance. That means that they're more inclined to, relieve us. And so that there's going to be less pressure on businesses, less pressure on individuals, and therefore, economic growth will continue. So that's some things to think about. I don't want to turn you into an economist. I just want you to be thinking about your business and where we are from an economic standpoint and how you need to position. And you want to be either more aggressive or less aggressive, depending on whether it's going to be a softer or harder landing. Now, next quarter, we'll talk about the same thing. Probably about that time, we'll know whether it's going to be a little bit more of a softer landing or a harder landing, or at least have more insight on it. And none of this is perfect analysis. It's all really just you're piecing together so that you have a more intelligent view of where things are. And that's really what we're trying to do here.